Welcome back to Trade in Your Job with Matt. Today's video will be a brief update on ticker symbols TLT and TLTW, fellow financial independence seekers. If you haven't noticed lately, they are getting clobbered as of late, and I saw something today that I think you should also know about. Sven Henrich, who's known as Northman Trader, took note today on X, which is also formerly Twitter, tweeting or posting, whichever you like to call it. Hear me out, the Fed is done and may actually have to cut rates sooner than anybody expects, and here's why. The U.S. government torrid debt spree, $600 billion in just the past month alone, has exacerbated the move in yields due to supply and demand imbalances. As inflation has been coming down, this is now overtly risking in an effectively over-tightening in market condition, even if the Fed no longer raises rates. Several Fed speakers have already indicated that rising yields are doing the job for them, but the velocity of the move in yields has become so historically extreme, over-tightening may be the end result here. In this case, Fed policy could rapidly be out of sync with economic reality. Major implication, they'd be mad to raise rates again. It makes no sense. What's the Fed's immediate choice if they are cognizant of this issue? For one, indicate they are indeed done on November 1st. This would alleviate some pressure on yields, but to the extent inflation continues to fall and yields remain elevated, policy will end up in an over-tightening condition. This would then force the Fed to cut sooner than currently expected. A further consideration, $600 billion a month in debt issuance is also not a conceivably sustainable pace, as it implies $7.2 trillion in additional debt issued over the next 12 months. Highly unlikely, which implies the supply-demand equation will shift, also easing the pressure on yields. If this eases yield pressure enough in the months ahead, then the Fed may not be forced to cut rates sooner than expected. If not, the Fed is in a heap of trouble, as is the economy. I suggest the Fed have a chat with Yellen and clarify what the debt issuance plans are going forward from here. Bottom line, either way, this current extreme move in yields is setting up for a reversal into next year. There is no other choice. If not, they can kiss their soft landing goodbye and risk a systemic break driven by another policy error. And then he goes on to say the original error was staying too easy for too long. Being out of sync with market reality, the new error would be staying too tight for too long, being again out of sync with market reality. Let's look at that with the chart that he shared as well. And this is the chart that he shared along with the post. It's the 10-year yield. You can see that since 2020, it's really just been on an upward tear. So that's what he means by the velocity of the move. And you can see how it's impacted TLT, down 12% for the year, 30-day SEC yield 4.92, and TLTW, which is the buy right strategy on it. It's getting income, so the year-to-date's not as bad. SEC yield is 3.59, and then option-adjusted yield 12.65. Then as we zoom in on the charts for TLT on the left and the US Treasury 10-year yield on the right, you can see that they're pretty much inverse. So in 2020, when yields started to go up, TLT started to go down big time. It's been quite a sell-off here. Looks like you're coming into an area of major support. If you go back, a number of years back here, there would be a support line right here. And then just the rise of this, we're in overbought conditions, which means oversold conditions on TLT. So from a historical perspective, the relative strength index on the monthly time frame over here on TLT has not gotten into oversold on this chart. And then the channel commodity index is a little more sensitive. Obviously, has gone into the oversold area a few times, but that has been times historically good to accumulate, especially when it's bouncing off a Bollinger Band, and that's what we're seeing right now. Could it continue to go down if the yields climb? Sure. But what's the other thing I notice is that there is a ton of volume coming in here compared to where we were, and you typically see big volume strikes on capitulation type moves. Doesn't mean there can't be even more. It looks like, as Sven is saying, the yields have risen so high so fast that it's likely that things will reverse. Here's the TLTW chart. That's the buy right strategy. It's only been around for a little while, so this is going back to September of last year. You can see same thing on this one. When it's hitting the lower Bollinger Band on this weekly time frame, oversold on both the channel commodity index and the relative strength index. MACD is really far apart. Usually that will resolve itself. Here's the US Treasury 10-year zoomed in just a little further so you can see we're in a big ascending wedge here. I'd be interested to hear what you think about this. Is this the time to load up on some TLT calls? I bought some the last few days, and I plan to buy some more if it keeps going down. Buying them, months out for expiration, and pretty close to in the money on the strike price. Also accumulating shares of TLTW, and be interested to hear what you're doing, how you're playing it, what you think is going to happen with this. If you have any thoughts, please leave them below in the comments. As always, thanks for watching. Until next time.